Well, g'day folks, we are now a week past the federal budget and hasn't there been some noise in the media? This week I want to take a look at the headlines that are directly impacting the property sector. And look, there is always hysteria in the media, but ultimately in reality, we need to look at this because this noise is what influences consumer decisions and drives overall market sentiment. Now let's start with the good. Following the federal budget, the principal place of residence has further strengthened its position as the absolute best place to store your wealth and avoid hefty taxes. At the same time, the self-managed super funds have somehow seemingly slipped through the system. The tax gains that you can now have in a self-managed super fund vehicle versus personal tax requirements has never been wider. We are also seeing now that existing homeowners can still purchase another property and lease out their former principal place of residence with negative gearing remaining completely available to them. Now, millions of homeowners are already eyeing off that exact loophole to protect their position under the new rules. And according to the ABC reports, over the weekend, first home buyers were actively up and about at auctions and noticeably buoyed by these specific tax changes. Now, I'm not sure if that's true, but anyway, let's get into it. Now for the bad. We were sold the narrative that this budget was all about intergenerational equity. We were told that it was focused on the property market and getting younger people onto the property ladder. However, latest data tells a completely different story. New data from KPMG has revealed that capital gains income from property represents just 37.1% of tax collected over the past 5 years. Now, 63% actually comes from non-property assets. As Brendan Ryan, a partner at KPMG, has bluntly put it, this is not a tax reform budget, this is a budget focused on gathering more tax. Economist Chris Richardson was equally straight to the point, stating that the tax changes will not solve our housing issues. He noted that the government has essentially used a tiny lever to hit the biggest rock in the Australian economy. And the fallout has also been immediate. Following the federal budget announcement, the major banks have moved incredibly fast to adjust their lending settings to investors. Macquarie Bank, well, they pulled the trigger first, and Westpac went next, announcing they will no longer honour pre-approved investor loans. The result on the ground, well, that's also been swift. Investors are largely pulling out of the market and dropping off ahead of auctions. Meanwhile, well, rents, they are rising at their fastest pace in 2.5 years, and Sydney has seen up to a 7.5% year-on-year increase according to SQM research data, and the budget, well, that's expected to accelerate that rental squeeze even further due to ongoing supply concerns. Now, there is an interesting back and forth evolving in the political landscape this week, with former Prime Minister Paul Keating jumping to the defence in the media to defend these capital gains tax changes. Yet at the exact same time, New South Wales Premier Chris Minns has called for urgent action to reduce the tax burden on everyday working Australians, including those hitting the 47% tax bracket. Now, Premier Minns is genuinely concerned that too many Australians are effectively working half their week for the government. Now, the irony here is that even Paul Keating, dating back to 2018, has been very firm that personal income taxes in Australia are way too high. So it's pretty hard to fathom how Mr. Keating can argue personal taxes are way too high, yet vehemently defend dumping more taxes on the public this week. So let's look at what's now really happening in and around the property market. Many property experts are now suggesting that property prices are set to tumble as investors flee the market, adding further pressure to the rising interest rate environment that's already in play. And they may very well be right. Also, looking at affluent areas, suburbs like Lane Cove on the lower North Shore have just seen a 280% increase in mortgage stress. Now, according to PropTrack's data, many of Sydney's blue chip waterfront suburbs are also experiencing the sharpest declines. They suggest areas like Longueville and Waverley are recording 20% price corrections, and Kirribilli tracking as high as 35% correction. Now, I'm never a huge fan of that data because it can really skew on monthly sale volumes, but the overall trend line is the key takeaway there. Now, buyers, they are out and about in the market. On the weekend though, they were openly describing the current market as like trying to catch a falling knife. But the big indicator, as we all know, is the auction market. And last week, clearance rates have absolutely crashed to 31.1% according to SQM research. We are back to pandemic levels. In fact, we're actually trending worse right now, with 8 consecutive weeks sitting in that 30% window. It appears the federal budget has pushed a lot of buyers further away from engaging in the market. Now, on the ground, we are experiencing what we are seeing as the widest gap we've seen between where a buyer is willing to trade versus where a seller is willing to let go of their asset. We previously have seen over these reports that a 10% correction was evident in the market, but over the last 14 days, buyers, in our view, have retreated even further. So here we stand, a market that is retreating, but buyers who are still very much active and in play. It really comes down now to whether sellers are going to meet the market or opt for a different path. Now, it's not a complicated market in that sense. Every agent out there right now is simply trying to find that trading line, and that line seems to be adjusting on a weekly basis. All the noise doesn't change the fact that great markets will always be great markets, but right now, everyone that wants to buy, they want to buy at a level that they feel is reasonable value in this current cycle. So that's what's going down in and around the property market this week. So many headlines, lots of noise, but still some great property and well priced on the market. And I look forward to catching you all next week.